Hey there, everyone. It's David Barnett from davidcbarnett.com, the blog site, YouTube, iTunes, SoundCloud, Google Play channel podcast, where I talk about buying, selling, financing, and managing small and medium-sized businesses. Today, I'm joined by attorney Trevor Crow from Crow.legal, who's in the Denver, Colorado area. And Trevor, your practice is all about business. You help people buy and sell businesses, and you also do capital raising transactions and helping people, comply with securities rules when they're trying to get investors and things that come into their business. How are you doing today?
I'm doing great. Thanks, David. I'm glad to be here again. Appreciate it.
Yeah, no problem. I'm having Trevor on the YouTube channel here today. Trevor was the expert guest speaker that came in to talk with the Business Buyer Adventure group coaching program back in September. And we did an extensive conversation about transactions and the legal work and some of the different terms and conditions that you've seen in the course of your practice. Some of the things that often people who are new to this don't really believe that some people may be able to get done in a transaction, for example. And then just before we hit record, you were telling me a little bit about a transaction you just went through, which I thought raised some great topics about something we could talk about today. And we're talking about a rollover, for example. And so why don't we have you explain what you mean by the term rollover so we can make sure everyone's following along.
Sure. Yeah. So, oftentimes if the buyer is a private equity type buyer or financial buyer who doesn't want to come in and actually manage the company, they're really just looking at buying the business as a source of revenue stream, then they often want the management to stick around. And so if the management owns equity in the company that they're buying, then what the best way to do that then is, instead of buying the assets and then the management getting taxed on that, and then having them buy back into the new company, they try to roll it over. And the rollover is usually, we attempt to do that on a tax-free basis. So the managers or the founders of the company can come over. And this can be a situation where it's small, 5% rollover. It can be, the recent transaction that I just did was three founders of an engineering firm, and they rolled over 30%, each of them 10%. Rolled over, and so the private equity company came in and bought 70% of the new co. And there's some complex reorganization entity stuff that we had to do prior to the transaction, but it was a sale of equity in the business, and so that and again, I don't want to get into all the details of the pre-reorganization, but once we did that, then the founders kept 30% of the company, and then the private equity firm came in and bought 70%. And so that's kind of what we consider a rollover. And so that's usually combined with an employment agreement with those rollover founders or managers that can.
Well, just before you get into that, I just want to recap quickly. So imagine you've got a company, and it could be formed in many different ways. It might be an LLC or a partnership or what have you. And there were three owners, and the private equity group wanted to buy in, make an investment. So before they did that, these guys had to create a new entity and then sell stock in that new entity to the investor group, so that the investor ended up being the majority shareholder. Now, in my book, Invest Local, I actually warn people about becoming minority shareholders in businesses, because shareholders, of course, get dividends. And as soon as you become a minority shareholder in something, you then have an interest in how the business is run, because if the majority shareholder is doing things that makes all the profit disappear, there's no money left for dividends. And this is what you're getting at about the employment agreements, because the three people who had their own business and now are minority interest owners in this new entity, they need to make sure that the profit that's generated in the business can actually fall to the bottom line so that they can get their dividends out, right?
That's right. Yeah. And so we have, several documents that now come into play in a transaction where there's a rollover that, if you're representing the seller, that you need to be concerned about, and so in my case here, we had employment agreements, which of course, the buyer wants, the idea behind the employment agreements is they want to provide an incentive for those managers to stick on and stick around, because they're a big piece of the business, especially in this transition period. But also that's the entity document. So we have the new co, and the buyer comes in and now owns 70% of that. That entity document is very important, as David mentioned, because Right. All the profits of that, if I own 30% of that company, I want to make sure that the profits are coming out and can actually get to me. But if those are getting wiped out because of the company becomes highly leveraged because the buyer comes and straps it with a bunch of debt, or two, there's a lot of management fees or things that buyer can come in and take off the top as management fees before it hits the bottom line or is available for distributions to the equity owners, then that's a problem. There are other things to be concerned about, or what other rights do you have? You're a 30% owner. Do you have a right to approve anything, major transactions, issuances of new equity? Because if the buyer comes out and issues a bunch of new equity to somebody else, that dilutes my 30% to something.
Right.
And so, do we have any protections there? There's just
and just for people that are watching along, what Trevor's talking about when he said just dilutes is that a company typically in its initial founding documents, there's either a limited number of shares or an unlimited number of shares. So in this example, if there were 100 shares and the three people owned 10 shares each and the investor bought 70, as a controlling shareholder, as a majority owner, if they decided at the board level to issue new shares to other people, say another 100 shares, then the 10% stake that the founders had would suddenly shrink to 5% because now there's 200 shares outstanding. So like it's not just how the money's being used. It's how the majority owner is going to make plans for this entity in deciding what they're going to do long term, if they're going to have other investors come in, all this kind of thing. These sellers really have to make sure that all the different angles are protected so that they don't, end up squeezed out, I guess would be a good way of putting it, right?
Yep.
Yeah. And so you're able to help prevent a lot of that stuff through the different contracts that you put in place?
Yeah, we try our best. I mean, it's a negotiation, and honestly, when you're dealing with certain private equity companies, they want a lot of flexibility because a lot of people are trying to do something like a roll up, for example, where they're going to be buying other businesses and rolling them up into trying to create a big platform type business. And so when they have that, their argument on their side is we need to have a lot of flexibility to do whatever. We need to be able to put debt on the company. We need to be able to issue new interest if we need to. We need to be able to do that. So it is a negotiation, and their response is a lot of times is you just got to trust us.
Well,
and
and so I did a video a couple of weeks ago explaining what a roll-up strategy is. But if the private equity group was using this particular firm as their platform and their intention was to go out and buy other businesses to roll it into this one, well, then these guys would have to be concerned that the value for them was improving over the course of these transactions and not declining, right?
Right. Exactly. Yeah. So it's definitely a give and take in a negotiation. So, we try our best to get as many protections as we can, and usually we can get comfortable with that. And to the extent we can't, it's talking to the sellers and saying, hey, here's the deal. And, this is what they are requiring in the agreement. We've pushed back on it several times. It doesn't seem like it seems to be a deal breaker. And are you willing to accept that as a business risk or not? And then we got to make a decision there. So, But yeah, I mean, in most transactions, we're able to get the reasonable protections that sellers want or would like to have in there and get the deal done.
So, a lot of people who build up a business and want to sell it one day, they envision the point of selling their business as, they get to leave. Oftentimes they know that there's a transition period of some kind, maybe a training period. What I've been seeing more of, particularly with respect to private equity groups, is that as the yields in public equities markets and things start to decline, they're looking for places where they can invest to earn more money. And then you start to hear about private equity firms that are buying up like veterinary clinics or dentist practices, like areas that they probably never would have gone into before, but businesses that could be very heavily driven by the personalities in charge. And so, does it make sense to buy a vet clinic if the vet's been around for 40 years and everyone in town knows the veterinarian? That acquisition, the value ongoing is heavily tied to that individual person. And so, this kind of thing is one of the ways that those groups try to make sure not only do we employ that veterinarian for a while so the goodwill could transfer to other employees, for example. But let's make sure that person has an incentive to stay on for the long haul. And making them part owner is one of the ways that they try to do this, isn't it?
Right. Yep. That's exactly right.
Now, this is not a small business that you're in your example here. This is a business that had several $1 million of revenue.
Mm-hmm.
You know, I often will have people that will book time with me to talk about doing a deal, and they'll start to talk about rather complex ideas about having partners and buying someone out over the course of time and things like this. And one of the things I often have to stop, and challenge people on and get them to reflect upon is that often they're trying to do things that are fairly complex for businesses that are quite small. And it often just wouldn't warrant all the work really that would be required to do to execute such a transaction. So in this case, in a ballpark way, like how long did it take you to do all of this stuff? Was it over the course of a couple months for you?
No, so this one, I mean, we were coming off. It should have been over 2 months, but
Okay.
we were swamped with another deal, and so we honestly couldn't focus on this as well as we should have until about a month out from closing, and so we were just hot and heavy on it for a month, and so this past basically all of September, we had been working really hard on this deal and focused on it, and so that like you said, it was a complex transaction. We had to do a bunch of entity restructuring stuff prior to we had to do what's called an F reorg. And before we could enter into the actual purchase agreement, it was a sign and close deal. And there was, a lot of negotiation on not only the purchase and sale documents that are typical in an M&A deal, but then we also had the employment agreements and the new entity document and all that because of the rollover that made it difficult, plus the reorganization, the F reorg that we had to do prior to closing. So yeah, I mean, this deal was double our, maybe double or 2.5 times our normal transaction fees, and just because it was complex, and it warranted the sale because, like you said, it was a multi-million-dollar deal, and the reorganization and things was going to save a lot of taxes and or at least defer a lot of taxes, and so it was worth it, and it made sense. But you're right, on a smaller deal, if this wasn't that size of company, it just wouldn't warrant those fees. It doesn't warrant $20,000 in legal fees to do a small deal. And if you're selling something for $200,000 or something like that, you don't want 10% of your purchase price going to attorneys, and so that it just wouldn't warrant it.
Yeah, and I will sometimes get into a conversation with people about asset sales versus share sales. And, the vast majority of small businesses are done as asset deals, just for a liability point of view and makes financing easier, et cetera. But as you get bigger and you get bigger and more complex entities that have maybe contracts in place with different customers, then it can start to make more sense to do a share sale because then you're not changing the entity. But let's talk a little bit about some of the impact that customers can have on these deals, because very often if the business sells to a large company or like a government agency or something like this, or, a branch of the government, if you got the contract to do the cleaning down at the courthouse, for example, those contracts may have in them some language about whether or not the contract is assignable to a new entity, or whether a change in control could give that customer a reason to break the contract.
Yeah, that's right. And so, the big question there is if you don't have an assignment, if there's an anti-assignment provision or a change of control provision in a contract, and you're doing an asset deal, then if those contracts are important, you want to get an assignments, those third-party consents to assign those contracts prior to closing. If I'm a buyer, I want to see those in place. Which is always a tricky thing to do because the deal hasn't closed yet, and you're already talking to vendors about potential sale, which is something you don't want to do. So yeah, that's definitely a tricky thing. Now, and if you're doing an equity sale of stock, or sale of membership interest in the LLC, typically you don't need a third-party consent unless there is a change of control provision. So, an example, this past deal that we worked on, that became an issue that wasn't really pointed out, or we didn't figure out until a week before closing, which was kind of stressful. And that one of the largest contracts that the selling company had had a change of control provision. Now, luckily, they had a great relationship with their customer and was able to talk to them and get the buyer comfortable that that's not going to be an issue. And I don't think they didn't have a signed consent, but they closed, buyer closed over it at the time. And I think they're getting a signed consent, but we're going to just get a signed consent post closing.
Now that customer probably though took great comfort in the fact that the three principals that they were dealing with before would still be the people that they were dealing with.
That's right. Yeah.
And that's the whole reason why the buyer wanted these three people to stick around.
Right. Yeah, that's
To
right.
help smooth this stuff over, right? Because they're the known quantities as far as the community and the customer base out there.
And then in the 30% rollover is skin in the game, so you know that they don't want, or the buyer has more reassurance that these guys want to stick around and want to make sure the company does better, because to the extent that it does, they get paid on 30% of that, so that they still have skin in the game.
In a lot of ways, the term you just used, skin in the game, in a lot of the ways, this rollover and keeping the sellers invested in the business provides a lot of the same advantages as a seller note would. For a buyer, they want that seller to continue to be invested, but it's certainly stickier and for a longer haul, because these people continue to be owners of the business, and they're in fact partners to a certain degree with the buyer, even though they're in a minority sense. But depending on how that shareholder agreement looks, I mean, these guys could negotiate the ability to veto certain big decisions, couldn't they? Even though they are minority owners of the business, it depends what that agreement says.
That's right. That's right. So we were able to get in certain things that require their consent, even though they only, collectively they only own 30% of the company. There was certain provisions, big ticket items that required, their consent before they could do. And this was kind of the issuance of new equity interests, which would dilute them. Mergers, things like that, we're going to require their consent. There were a couple others that aren't coming to my mind right now, but yeah, that we tried to build in those protections.
So great conversation, and I know this is going to be interesting to a lot of people out there. Have you, I want to turn the direction of this conversation here a little bit, but let's talk about what's been going on here recently with the whole coronavirus and all this kind of thing. You primarily are practicing in Colorado, correct?
That's right.
Yeah. And so what kind of impact have you seen on your M&A deals and maybe the types of deals that are coming through your office since the pandemic hit?
So we had a big slowdown, in April and May, and kind of every deal, middle of March, all the deals died. And so that made April and May pretty slow. Things are coming back. I'm seeing, really all kinds of deals. I have a restaurant deal that's in the works here. We have, this was an engineering firm. We got some real estate deals that were going, acquisitions of portfolios of real estate. I've seen a number of different industries. So I don't know. I feel like people are coming back, and I think there's money out there to buy. There was a huge, we just also had a kind of an inspection company deal that we had closed last month, and there was this big surge of people trying to close deals in the U.S. before the 27th
for the CARES Act deadline. Yeah,
to get that SBA 6 months paid for. So yeah, we had a big surge there. Honestly, I've kind of been seeing the gamut, and I don't know. I mean, I think I think what's going to come, and I haven't seen it yet, is more distressed deals. There's going to be a lot of people. I think it just hasn't hit yet where, the companies that kind of weathered the storm and are doing all right, I think, and now wanted to sell, those deals are getting done. There's going to be some companies that are really struggling and potentially about to go out of business that I think there's going to be some of those deals coming in the future. But, I honestly haven't seen those quite yet.
Well, I've had many conversations with people about that 6-month payment, under the CARES Act for the SBA loans that were outstanding. And I remember at one point, I think I said to someone, yeah, they did that to help small business, but they also did help themselves because the SBA just can't manage that many foreclosures all at once, right? I mean,
Right.
like if you bought a business in a highly leveraged way, if you got 90% financing on a business in December, and then were forced to close your doors because of a government mandate, just a couple of months later, how would you do that, right? And so now that we've reached the end of that deferral or payment coverage period, now those people have to start paying. And I agree with you. I think that the beginning of the repayment of those loans again could be the thing that pushes a lot of these businesses over the edge.
Mm-hmm. Yep. I can totally see that.
Yeah. Trevor, just before we wrap up here, why don't you let everyone know the kinds of stuff you deal with and where they can reach you and what kind of people should be reaching out to you that might be able to use your services?
Yeah, thanks. So Trevor Crow, attorney in Denver. We do a lot of deals in the Denver Rocky Mountain region, but we also do deals, have done deals across the U.S. Website is www.crow.legal. So there's no .com in there. It's crow.legal, CROW, no E. And then we have my number is 720-230-7123. You can call me directly there, or email is just trevor@crow.legal.
Awesome. Well,
Yeah.
thanks very much, Trevor, and thanks for sharing the story with us. And we'll talk to you again next time.
Sounds good. Thanks, David.
And for anyone who's out there who hasn't already, please head on over to my blog at davidcbarnett.com and join my email list. I send out emails all the time, and you get to choose what topics you're interested in. And if you enjoyed a video like this, you can make sure that you never miss one by getting the email that comes out every Wednesday with the new video. And anyway, we'll see you later.